Welcome to five economic experts in dialogue on the 10th year following the failure of Lehman Brothers. Special thanks to the sponsors of this organization, the Campaign for America's Future, Our Revolution, Northern Virginia, Public Citizen, Fairfax County Democratic Committee, National Affairs, the American Prospect, National Latino Farmers and Ranchers, Rural Coalition, Our Revolution Arlington, Loudoun Progressives, Americans for Financial Reform. My name is Bart Naylor. I am the financial policy advocate for Public Citizen. Public Citizen was founded by Ralph Nader about a half century ago. I like to think of us as an impossibilist organization trying to achieve the best. We don't take yes for an answer. 10 years ago, at this time, we were experiencing a financial crash. On September 15th, Lehman Brothers went bust. As Oscar Wilde might have said, if it's a tragedy to lose one brother, but it's reckless to lose two brothers. The day after, one of the largest money market funds, Reserve Primary, broke the buck. We can go into what that means. A money market fund was not giving you back what you put into it. A few days later, our Treasury Secretary proposed a bailout. On Sunday, the 21st of September, the Federal Reserve met and turned Goldman Sachs and Morgan Stanley into bank holding companies, therein allowing them access to essentially unlimited bailout money. President aspirant McCain suspended his campaign a few days later and met, along with Barack Obama, with Hank Paulson to assess the situation. Things were looking pretty grim, and yet the Dow on October 3rd hit a record of 14,000. In other words, even in the midst of what we now know was disaster, the so-called smart money, or people that were betting with their own pocketbooks in Wall Street, thought things were not just good, but that was a record. And we'll go into how the opacity of Wall Street is one of the serious problems. What did happen later? Well, what happened is that we lost trillions, perhaps 13 trillion in lost savings. At least 11 million people were displaced from their homes. From 2007 to 15, there were about 15 million foreclosures. I noted the running tally of how much we were underwater, and at one point it was $700 billion that we were collectively underwater on our mortgages, meaning we owed that much more than the value of the homes. And I thought that was a suspicious number because there was another number, namely in early October, that was the TARP bailout, basically the same amount. 9 million people lost their jobs, and by accounts, the most expansive account of unemployment, it reached essentially 17%, including those who had even given up looking for a job. There is no question with what I'm about to say. This was very bad, and we don't want it to happen again. This was a tragedy that we know to this day. Polls affirm this, that we have not forgotten this devastation. These polls not only come from the very fine work sponsored by Americans for Financial Reform, but also by the Cato Institute. The Cato Institute polls show that a bipartisan group of people think that Wall Street needs to be bridled, that the crash was bad and should never happen again. With me tonight are four experts on this issue, people that were there, people that, in the case of Nomi, worked for some of these firms. She will begin. I think that all of you have her background. I think she worked for half of the firms on Wall Street, including Goldman Sachs and Bear Stearns and Lehman Brothers. Following Nomi will be Marcus Stanley, my colleague at Americans for Financial Reform. when I was a staffer at the Senate Banking Committee, and we actually were talking about getting rid of Glass-Steagall in the 1980s under the chairman that both Bob Kuttner and I worked for, Proxmire, there really were no citizen lobbyists, at least that I was aware of as a staffer. This was a contest between banks and insurance companies and mutual funds and so forth. But there really weren't very many citizens. I'll make an exception to that. There was a public citizen guy named Jonathan Brown that would come by. But it really was a debate between bank lobbyists. And now I think that Marcus Stanley goes toe-to-toe with the most informed, credentialed, and well-paid bank lobbyists that there is. Thanks to him, we are able to proffer some of the most robust and sophisticated arguments. Following Marcus, we'll be talking to Professor Art Wilmarth. Unfortunately, in my view, there are two types of economists: those who get outside funding by Wall Street and those that don't. And with the former, you can tell by looking at the footnote first, if they do disclaim their funding, where their study is going to go. And if they don't, then read on, because it's likely to be a dispassionate account. We're very lucky to have Professor Wilmarth with us tonight, and frankly, with us every day as sound academic insight is provided. And then, following that, we'll hear from Bob Kuttner. Bob and I actually had the same job for Senator Proxmire, but I will ask him at the end. He won't be talking about this largely. Anybody heard of the Community Reinvestment Act? Yeah. Well, we can thank the senator and his able staffer, Mr. Kuttner, for that. So, with no further ado, let me turn it to Nomi.
Thank you, Bart. You guys can all hear me, and gals? Okay. I'm not going to lean over on this like this. You know, I was when I came here tonight, I heard a bunch of you say, "Where's the Lehman event?" And it just took me back in time, because the Lehman event would be one of many sort of gala things that would happen for us when I was working on Wall Street. I think that the first book that I wrote, Other People's Money, in 2004, The Corporate Mugging of America, starts with not a Lehman event, but a Goldman Sachs event. It was a Christmas party. And they pull out all the stops for these parties, and we have the happy anniversary, the 10th anniversary balloons here. That's what we got here. So that's kind of what we do. But these kind of gals, the sort of lavish expenditures that happened through my career on Wall Street were so nuts. And I did open that book with a scene from the Javits Center in New York City, and sort of going up these escalators. You're nodding. You read the book, and coming into this winter wonderland, and I mean weird shapes of icy things, and white and purple fairy things, and just this completely transformed space. And Hank Paulson is sort of holding court, sort of the end of this, and sort of this array of white sort of table-like things encircling him. It was sort of like this weird Lord of the Rings meets Game of Thrones meets, I don't know. But so the book ended, though, with a warning about some of the stuff I was actually doing on Wall Street before I left, which was in the field of credit derivatives and CDOs, collateralized debt obligations. Wall Street's really big on acronyms to sort of keep people from trying to figure out what it is they are talking about. It's it's collections of stuff. Oh, I know, we'll call it CDOs, collateralized debt obligations. But basically what those were, and it became part of the crux of the financial crisis, because what we did, and I say we as the old we, when I was part of that we on Wall Street, was to take simple financial instruments, simple securities, simple loans, and kind of turn them up into much more complex securities, because there was a rule that basically the more you could recreate a security out of the same little piece of thing you started with, the more money you could get along each iteration of that. So the more you could stick on credit derivatives and things called synthetic credit derivatives, as if credit derivatives weren't enough of a complication, onto securities, onto loans, onto all sorts of other things, the more money was made by multiple desks at Goldman Sachs and other places. And the thing to also note, and I've said this in other instances, that everything that goes into these concoctions, the bank that is creating them knows how they will perform. One of the big lies about the financial crisis was that it was all related to the stuff that Bob did, basically. It was all related to people being able to take out loans in multiple parts of the country, which became subprime loans because banks decided that the more they could eke out of giving those loans to people, the more interest they could eke out, the more they could on each of those churns make that much more money because they're starting from a level where they're already extracting more from the loans that they're extending. And so the result of that was that in the concoctions, in the iterations, one loan from one house in one place in, say, Stockton, California, could be utilized in multiple different transactions and multiple different complex securities. So this poor little loan, or the borrower who, let's say, can't make ends meet and can't necessarily make a payment and has to default on their loan, whereby the bank that extended that loan is like, well, sorry, we can't readjust your loan and we can't sort of work with you. All of a sudden doesn't have the ability to pay interest to that loan. So that interest that is now counted upon by all of the multiple securities, all the different complex iterations that all of the different Wall Street companies are concocting out of this one little loan. And it might not even just be one bank that's doing it. This one little loan could show up in literally hundreds of places. And I know Marcus actually has had charts on this kind of thing, but it can show up in a lot of places. And every place it shows up, it makes somebody else money. And every time that borrower can't pay off on that loan, they were losing their homes, as Bart talked about in terms of the major numbers. But that mechanism, here we are, the 10th anniversary of how subprime loans became a financial crisis because banks concocted securities and then lended against them to other banks who then bought them. My old company, we're here to commemorate its demise. It didn't lend money to people to buy homes. That was not its day job. What it did do was buy boatloads of these complex securities and create boatloads of these complex securities, at the bottom of which were some of these loans. And then they borrowed more and more money, or they leveraged themselves more and more to buy more and more. And at one point, they got to a situation where they just couldn't repay the money they borrowed to buy these complex assets, all of their day-to-day activities. And that's ultimately when that late night happened here, basically on the Hill, to discuss how to, to help the financial system, whether to let Lehman collapse and what to do with the other banks who had all done the exact same thing. Lehman was just sort of unlucky and unconnected from a relationship perspective, the same way Goldman Sachs was very connected from a relationship perspective. Goldman Sachs had the same exact problem that Lehman Brothers had, give or take. It had borrowed money, it had created assets, it had bought more, it had leveraged against them. However, it just so happened that the Treasury Secretary of the United States was that very guy who was standing in the middle of the white tables that night on, before Christmas, a guy named Hank Paulson. And there was literally no way, his old firm was going to be a casualty. And as a result, a lot of stuff happened, of which we are now commemorating 10 years. But before I hand it over to Marcus to go into all of the amazing research that he does and the details, one of the things that has happened to subsidize this entire process, besides the fact that all of these banks can still do this. JP Morgan can still lend money to Goldman Sachs to leverage their toxic assets. They can also buy loans. They can also restructure those loans into more securities. They don't do it with subprime loans today. They do it with corporate loans, because that's been the thing that has replaced subprime loans in terms of where banks can make the most money, eke out the most at the bottom to sort of complexify up. I don't know if complexify is a word, but you get what I mean. And one of the things that happened besides the bailout was that the Federal Reserve stepped in. At the time, it produced a lot of different programs which we all talk about, which I talked about in my book, It Takes a Pillage as well, that literally allowed different forms of avenues to get money to all the banks who had done all the activities that they had gone through to complexify this entire environment, and basically give them money to float themselves, to live another day, to pay their operations, to continue to survive. But that wasn't even enough. We are still in a situation where the Federal Reserve has effectively electronically created almost what is now $4.2 trillion worth of money in order to subsidize the banking system. That part of that money was used to buy what's now $1.75 trillion worth of mortgage-related securities that were overvalued by the Fed. So basically, it's like, we'll give Wall Street banks more money than the stuff that they're giving us is worth. They can do whatever they want with the money. They'd have no strings attached to that money. And we'll just keep the mortgages, with us. We're good. We've got this. And another $2.5 or so trillion of treasuries, which allowed the government to basically have the ability to create more debt, have it go through the banks, have the banks get the money for that debt, and have it then ultimately sit doing nothing on the Fed's book. So effectively, the Fed is still subsidizing the banking system to the tune of $4.2 trillion. It's not just the Fed, it's a global situation. There's a number of G7 central banks that are doing this in different ways in the wake of the financial crisis. It wasn't just a U.S. thing, it was global, it's still global. That money could have been not created to subsidize the banks. That money could have been created to subsidize sort of real economic production and growth and infrastructure spending and student loan, subsidizing. It could have been used to do a lot of things. And I was just talking to Bob at dinner just before coming here, and it's like, it was a choice. We were saying it was a choice to decide that producing over a period of a decade multiple forms of subsidies for the banking system, for finance, in order to go into financial assets, instead of putting them into, or not doing it, or putting that money into the real economy in multiple different ways. That was a choice that's made. And I think if there's one thing we take out of here, it's to realize that, and to realize that the pressure that should be put on the people that have made these choices, on the elected officials that could stand up and say this, that there are multiple ways of sort of not doing this. There's Glass-Steagall reinstatement. There's all sorts of different things that can be done. But ultimately, that choice has to change. Choose the American population. Don't choose Wall Street.
Thank you.
Okay, Nomi is a tough act to follow, and I can't compete with that cinematic introduction she gave of the party on Wall Street in 2004 and the boom days. But I was on the Hill 10 years ago, and I wasn't at that. I was not a big enough person to go to that famous meeting where Bernanke, Geithner, and Paulson went to the Hill and demanded $1 trillion overnight, or else there would be catastrophe in the U.S. economy. But I did hear about it very quickly afterwards, and people were stunned, because just the failure of Lehman Brothers, it was assumed that this was something that we could handle, and wouldn't be the kind of world historic disaster that it turned out to be. But we are here on the 10th anniversary, not just of the failure of Lehman Brothers, but of the political choices that were made in response to that failure, of the choice of the bailouts and the assistance to Wall Street that was given. And I think that that's something that's very important to look at as well, because that gives us really something of a warning of what might happen the next time that there is a recession. And we really can't afford to repeat that experience again in terms of the choices that were made for Wall Street over ordinary American people. Steve Bannon, I don't know if people saw this, Steve Bannon, the famous impresario of Trump's campaign, he was interviewed on the 10th anniversary of Lehman Brothers, and he was asked about the financial crisis, and he said, "The rise of Donald Trump began that day when Bernanke and Paulson and Geithner walked into Congress and asked for a blank check for $1 trillion. Because that decision so undermined the legitimacy of our economic and political system that people were willing to, it delegitimized our political and economic system so much that people were willing to turn to anyone. And we're still we're still experiencing the long-term impacts of that. But what really worries me and frightens me is that I don't believe that our elites have really learned that lesson. I don't know if people saw this, but Bernanke, Geithner, and Paulson, that same trio, wrote an op-ed in the New York Times a couple of weeks ago for the anniversary of the crisis. And, you could have expected some self-examination, certainly, because these were all very powerful regulators before the crisis, and their decisions helped lead to the crisis. But there were only 10 words in that op-ed that dealt with their own it was something on the order of mistakes were made. There were things we overlooked. And then they moved on and they said, what is the great problem we face today? The great problem we face today is that certain legal limits have been put on our ability to bail out the banks, and we need to reverse these limits. This is the op-ed. It's really amazing to read. And what's even more frightening about it is that, in fact, very few legal limits have been put on their ability to bail out the banks. The full story of what the government did for Wall Street and the full contrast of what the government didn't do for the rest of us is something I think not a lot of people appreciate, because it's not just TARP. The Federal Reserve basically started creating money to pump into the banking system in 2007 and ended up creating so many programs that there was a period of a solid year from 2008 to 2009, about 50 consecutive weeks, when the Federal Reserve had between $500 billion and $1.5 trillion in loans out to Wall Street for every single day of those 50 weeks. They had basically about $1 trillion of credit out on the street. And if you look at 2009, the banks returned to profitability very, very quickly over that period. But that was the period where 9 million jobs were being lost, millions of people were losing their homes. And that assistance, that the money that I just quoted, that's not even TARP. TARP is an extra $750 billion on top of that. And then on top of that is a whole set of guarantees of all the borrowing the banks were doing and all the assets the banks had, that if the banks couldn't pay back their loans, the government would. So that is just an absolutely unprecedented commitment of the federal government's financial muscle to help support and save those banks. The legal authority that the Federal Reserve used to do that, which is under Section 13.3 of the Bank Holding Company Act, that authority had only been used in the entire history of the last 80 years since it had been passed for a few dozen loans totaling about $1 million. That's the full amount that it had been used. But of course, it was used at an unprecedented level over those 2 years. And now, in their article, they essentially said that this was necessary firefighting authority that all financial regulators had to have. And they presented it as a routine authority that we would, from now on in the future, be drawing on routinely. And in fact, in the Dodd-Frank Act, that authority was more or less validated. Congress said you could continue to do this, but pretty please, next time you do it, don't do it for one particular bank. You have to do it for multiple banks so it doesn't look like favoritism. That's the only limit that was put on it. And that is the limit that they were saying in this op-ed was so constraining that they couldn't live with it. We have to be able to bail out a single bank. It's too constraining that we might have to actually have a program that helps multiple banks. So, I mean, you couldn't make this stuff up. It's just amazing. So when I look at that, I say our elites and the people at the top of our regulatory system really have no faith in these protections that have been put in. Mm-hmm. The only faith that they have is their own undemocratic authority to use public money and to use the force of the federal government to effectively bail out the financial system. And when you look at what Congress was able to do for ordinary people in the wake of the financial crisis, in 2009 there was a stimulus passed. This was an economic stimulus in response to the crisis. It provided $750 billion, sounds like a lot of money, to food stamps and other programs that reached regular people. About half of that $750 billion was tax cuts for businesses that were supposed to be stimulus. So only about $375 billion went to state governments, went to ordinary homeowners, went to the poor, about $370 billion. We just saw the Republican Congress under Donald Trump passed a $1.5 trillion tax cut, almost all of which went to the wealthy and corporations, twice the size of that stimulus program passed in the wake of the financial crisis. And they passed it in December 2017 when there was the wealthy had made out like bandits for the past decade. So that's the state that our government is in, where in response to the worst crisis since the Great Depression, we were only willing to give a pittance in comparison to what we just showered on the wealthiest people in this country. And coming into the, it really frightens me what we might see in response to the next crisis, because people like Bernanke, Geithner, and Paulson are going around saying they saved the economy. Well, we cannot afford another success like the one they had. I'd hate to see a failure if that's a success. So we really need to prepare for that next moment. And as Bernie Sanders has said, have a political revolution before we reach that point. Because if we repeat those priorities, we're going to be in a lot of trouble.
Thank you, Marcus. Thank you, Marcus. Before Professor Wilmarth talks about some possible solutions, I'd like to talk a little bit about scale. We're using a lot of big numbers. If I was to hand Nomi $1 million by giving her $1 every second for 24 hours a day, it'd take me a couple of weeks before I gave her $1 million. And if I kept going and wanted to give her $1 billion, that's B as in boy, it'd take me about 30 years.
Jeez.
30 years. And if I wanted to give her $1 trillion, it would take me 30,000 years. 30,000 years ago, by the way, Homo sapiens didn't know how to farm. So Art's going to talk a little bit about, we've all been talking about these bailouts. So there's a difference between $1 and $1 million and $1 billion and $1 trillion. And so Art's going to talk about some banks that are in the trillions.
Well, thank you very much, and I appreciate being here with my distinguished colleagues. Marcus mentioned and others have mentioned that this was the worst financial crisis since the Great Depression, and that's not an accident, because the 20 years that preceded it were the biggest credit boom since the 1920s. And there are other interesting parallels. Financial compensation had the biggest gap with regular compensation in 2007 that it had had since 1929. In other words, that big finance was as unleashed in the 1920s as it was in the 1980s and 90s. And of course, they learned something from the 1920s and the terrible crash that followed it. Of course, they learned it because essentially until 1933, not much was done to prevent the spiral downward. So in a sense, the people felt the full force of the Great Depression until FDR came in. Unemployment reached 25%. 25% of the workforce was out of work. It was just absolutely devastating. I mean, people literally starving. So there was tremendous anger at Wall Street for what had happened. Even then, the anger wasn't very well directed until someone named Ferdinand Pecora came along, and he was the chief counsel for the Pecora Committee that investigated Wall Street's role in bringing on the Great Depression. And shall we say, he was a very gifted investigator and cross-examiner and brought a lot of the scandals to light in ways that scandals have not been brought to light after the last crash. But certainly the kind of credit booms that occurred could, in my view, could only occur because in the 1920s and beginning in the 1980s, we allowed banks to get into the securities markets, right? And banks have three enormous advantages. One is they have deposits. In the 1920s, they didn't have deposit insurance, so the banks in the 1980s and 90s had even a greater advantage. They had deposit insurance behind them. But the banks had deposits, and they had supposedly reputations for integrity, right? You could trust the banks, right? People trusted them. And third, they had a lot of customers, so they could mobilize a lot of customers. What happened in both the 1920s and then more recently was that banks were able to use their deposits to make lots of very speculative loans and then to package them up into securities that were sold to customers around the world, but particularly to depositors and other customers who trusted them. So you have this massive explosion of foreign bonds and very risky domestic corporate bonds in the 1920s, followed by risky stocks and risky what were the forerunners of mutual funds. And if you look back at the 1980s and 90s, to me there were three drivers of the financial crisis that would simply have been illegal, unlawful, couldn't have been done if Glass-Steagall had remained law. Breaking down Glass-Steagall was a 20-year process because the banks got the regulators first to keep punching loopholes in it, right, and weakening it. And then finally, they got Congress to repeal it in 1999. But let's look at the three drivers, in my opinion. One Nomi has mentioned was securitization, because when banks could only make mortgage loans and had to keep them on their balance sheet, you could get into trouble, right? The S&Ls got into trouble doing that. You could get into serious trouble, but you couldn't probably crash the entire economy doing that. But once you could take loans and package them into mortgage-backed securities and then sell them out around the world, there was a lot of demand for AAA securities, right? They package these things up, and for every RMBS package, there would be 80% AAA strips or tranches, and people wanted those because they paid more than AAA treasuries and other AAA. Well, they had a problem, though, because the bottom 20% were hard to get rid of. That's where CDOs came into play, because basically they created CDOs to take the lower rated stuff in RMBS that weren't very attractive. They packaged that up and said, oh, now we have 80% of CDO AAA strips, and they sold those. Well, okay, so again, banks couldn't securitize loans until Glass-Steagall was undone, right? And they couldn't create CDOs, either RMBS or CDOs. Then the second thing came along, which were over-the-counter derivatives, right? And Nomi mentioned those too. Well, the critical play here was the credit default swap, because a credit default swap was essentially insurance. It was a guarantee. Banks couldn't give guarantees or insurance either under Glass-Steagall, but we created another loophole for them. How did credit default swaps play? Well, if you could get credit default swaps from somebody like AIG to back up the top strips on your CDO, suddenly, the credit ratings agencies would give AAA ratings to your CDOs if they were backed up by AIG, and the banks would say to AIG, hey, come on in, give your CDS, we'll pay you a nice fee for that. And so they were able to take all the unattractive lower level RMBS, package that into CDOs, sell the CDOs, and then, hey, if we can't sell all the CDO strips, let's create something called a CDO squared. You just kept running the same play over and over again. And as Nomi said, you have a pyramid of bets, right? So here down at the bottom are these mortgages, these non-prime mortgages, which have been packaged up. The lipstick's been put on the pig, right? And you took a bunch of non-prime mortgages and called them RMBS and called them AAAs, and people think they're buying AAA securities, but down underneath is non-prime mortgages. So there's non-prime mortgages, but you've got RMBS, CDOs, CDS. You have a multiplication of bets sitting on top. So when the mortgages start defaulting, it's not just $1 defaulting. It's multiple dollars, maybe $7, $8, $10 defaulting for every mortgage defaulting. So you had this incredible multiplication, aggravation, acceleration of defaults. So we said securitization, over-the-counter derivatives, and the third one was shadow bank deposits, because not only the banks got big, but Wall Street got big, the big five securities firms. Well, they couldn't have gotten very big if they couldn't offer the equivalent of deposits, right? People forget that Glass-Steagall did two things. One is it said, banks, you may not do securities business. Stay out of the capital markets. Do commercial lending. Do deposit taking. Provide payment services. But the other part of Glass-Steagall was securities firms, stay out of banking, which meant you cannot take deposits. What are deposits? Short-term debt instruments payable at par on demand. Okay, what was Wall Street using to fund itself? Oh, money market mutual funds. Short-term debt instruments. They weren't called debt, but they were. People thought they were. Payable at par on demand. We know what happened when suddenly they broke the buck. The government had to rush in and guarantee every one of them. Those should never have been allowed, right? Repurchase agreements, overnight repurchase agreements, which were a form of secured lending. 1 day, 2 day, 3 day debt. Again, that couldn't be permitted for securities firms under Section 21 of Glass-Steagall. Short-term commercial paper, 1 day, 2 day, 7 day. At the time the crisis hit, you had $3.5 trillion of money market mutual funds. You had, nobody knows how many repos there were, maybe 3.5, 4 trillion. You had a couple trillion of commercial paper. So there was actually as many or more deposits sitting out in Wall Street as there were true deposits sitting in the banking system. They were being used for just as speculative purposes. So you had $18-20 trillion of hot money, being used to chase really speculative bets around the world. Glass-Steagall would have prevented that if we hadn't torn it down. Why did Wall Street and the banks spend 20 years trying to tear it down? Because it restrained them, right? It kept them doing from what they wanted to do, which is to gamble. The simple response after the last crisis would have been to say, let's go back to the system we had in 1933, which was a segmented system where you didn't have a crisis in the banking system automatically taking down the capital markets, or a crisis in the capital markets automatically taking down the banking system. But we didn't learn, right? We didn't learn our lesson. Of course, I'll close with a quote from Upton Sinclair, who said, it's really hard to make a person understand something when their whole way of life depends upon their not understanding it. Who was running Congress even in 2010? Pretty much the banks, right? I mean, not totally, but pretty much, right? It took a miracle to get Dodd-Frank through, even as weak as it was. And the banks have only gotten stronger, since 2010. So I think we need to look back at history and say Glass-Steagall was right, and basically we paid a big price when we got rid of it. Thank you.
Thank you.
So let's pretend that we are having a 10th anniversary event on the 10th anniversary of the collapse of 1929. And it's October 1939. And we're looking back on the previous 10 years. And what do we find? Well, we find the Securities Act of 1933 and the Securities Exchange Act of 1934. We find Glass-Steagall. We find deposit insurance. We find Homeowners Loan Corporation and Public Fannie Mae and Public Utilities Holding Company Act. And the banking committees are drafting what becomes the Two Investment Company Act of 1940. We basically turned Wall Street into a public utility that ran like a Swiss watch, so that Wall Street could never do this again. And that set off about a 60-year boom, because we insisted through all of these wondrous pieces of legislation that finance be the servant of the real economy and not the master. We had the Reconstruction Finance Corporation, where, yes, we put public capital into a number of companies, a number of banks, but there were quid pro quos. There were public officials on the seats of these boards. There were limits on executive compensation. And the intriguing question is why we got it right after the collapse of 1929, why we got it so wrong after the collapse of 2008, and of course, Tonto's epic question to the Lone Ranger: "Who's we? What do you mean we?" Now, Marcus was lamenting the fact that these guys, Bernanke and Paulson and Geithner and company, seemed beyond persuasion. And of course, the point is not to persuade them. The point is to crush them and displace them. And so you actually had radicals running the government some of the time in the 1930s. You had a populist chair of the Fed, Mariner Eccles. And wondrous things happened, and the real economy thrived, because the sort of hyper-financialization that we had before 1929 and before 2008 was prohibited. You couldn't do it. So what happened? Well, Wall Street escaped the box, the salutary box that it had been put in, beginning in the 70s, 80s, and 90s. I was working for Proxmire in the 70s, and even in the 70s, Proxmire, just a magnificent human being, public servant, was weakening on the subject of Glass-Steagall. I think I was the only person on the staff at that point saying, "Don't do this, you don't want to do this," because the siren song that the commercial bankers were telling Proxmire, who really believed in competition, was, "Hey, look at this picnic the investment bankers are having. They're making money hand over fist, and we commercial bankers are getting just clobbered by maturity mismatch. We're lending long with fixed rates, and we're taking deposits with rates that keep going up, and we're getting creamed, and let us into their garden, and we'll have competition, and prices will fall, and the consumer will benefit." And Prox said, "Yeah, that doesn't sound so bad." And so they succeeded in neutralizing just about everybody. And as Professor Wilmark indicated, this was done bit by bit by bit, first with regulatory loopholes, and then by the time they finally repealed it outright in Graham Leach Bliley in '99, it was a formality. It had in effect been de facto repealed. So why did we get it so wrong the second time? Well, the answer is both parties were in the tank for Wall Street. And the villain of the piece, who cannot be villainized too much, is Robert Rubin, who started out as a fundraiser and assembler of funds for not Bill Clinton. He started out with Walter Mondale, and little by little wormed his way into the position of sage, where he was not only bundling money and giving money and identifying donors, but he started calling the tune. And so the worst of the deregulation really happened under Clinton. And to make matters worse, if you fast forward from the Clinton administration to the Obama administration, unlike Roosevelt, who had the wit not to hire Hoover's team, Obama hired Rubin's team. Obama hired the people who put the economy on a trajectory that ended in financial collapse that got Obama elected. And instead of hiring people to clean out the stable, he hired the guys who did it. Can you imagine? It's not like there were no dissenters. I mean, I vividly remember, I wrote a book called Obama's Challenge, and I took a little bit of a risk. I wrote it before Obama was elected. It was published before Obama was elected. In the spring of 2008, I took a risk that A, there was going to be a financial collapse, B, Obama was going to be the nominee, and C, Obama would be the beneficiary of the collapse. Now, the one thing, so that's pretty good. The one thing I had not imagined was that Obama would hire the team that did it. So from the get-go, you knew that we were not going to get a Roosevelt-scale radical reform of the financial system. The die was cast. You simply could not get radical reform if the people who were in charge were Geithner and Summers and the reappointment of Ben Bernanke. So Dodd-Frank, what became Dodd-Frank, the Treasury draft of Dodd-Frank, was too weak going in some respects due to the really heroic effort of some great members of the House and Senate, it actually got stronger in the course of working its way through Congress, something that almost never happens with financial reform legislation. And then, of course, the rulemaking process just gutted it. And so Wall Street, here's Wall Street. The big banks are more concentrated than ever. The business model is basically unchanged. And we have the resurrection of old abuses in new forms, and we have new abuses. Private equity, which was originally a loophole in the 1940 Investment Company Act, is now destroying retail. It's destroying newspapers in this country. Grocery chains are just being decimated by private equity ownership. Whenever you see a company go belly up and workers being laid off and pension funds being tossed overboard through bankruptcies, the odds are that the ultimate owner of that operation is private equity. And that's just below the radar. Only a handful of people writing about this. You've got the abuse of bankruptcy. You've got the failure to enforce antitrust against new kinds of platform monopolies that had not been envisaged by Messrs. Sherman or Clayton. And on and on and on and on. And of course, this is how we got Donald Trump. This is how we got Donald Trump. When regular people realized that both parties were in the tank for Wall Street and wondered where the opposition party was, the opposition party turned out to be neo-fascism. And we're seeing that in Europe. We're seeing that in the United States. I wrote a book about this called Can Democracy Survive Global Capitalism? Because a certain kind of globalization, the use of globalization to promote neoliberalism, which was the antithesis of the kind of globalization that we had at Bretton Woods in 1944, which was globalization in service of a managed form of capitalism. This was globalization in service of universal deregulation or universal privatization of regulation, turning its back on ordinary people, so that when Hillary Clinton or whoever runs for president, the average voter says she cares more about Davos than she cares about people like me. Mm-hmm. And then you add sexism and racism on top of it, and Donald Trump wins. Well, Donald Trump is not exactly the scourge of Wall Street. Steve Bannon may be right that the bailout laid the groundwork for Trump. I think that's absolutely true. And yet, talk about cognitive dissonance, Trump is the ultimate handmaiden of Wall Street. So the only way we're going to get beyond this is we need to have a do-over big time, and we need the politics, we need the political leadership to elect people who have some credibility, who have some vision, so that we can put Wall Street back in its box, this time for keeps.
Thank you, Bob. I'm going to ask a few questions, and after that, I'm hoping that some of you might have questions. And heads up to Mr. Pelletier, I think I might have one for you as well. We have one of the premier superstars on the issue of Too Big to Jail with us, one of the few heroes on that subject in our audience. Nomi, the last crisis was built on mortgage debt. For years leading to the crisis, the home ownership rate was about 65%. And we were promised that through this miracle of securitization, where banks could be replenished with money by selling off their loans through the miracle of securitizations, that they would have that money to make more loans. And it went up to about 69%. We've now had a crash where some of that securitization has been proven toxic. We're back down to 65%. One of the lessons may be that only so many people in America can afford to buy a home. The rest of us should be renters, or we should be saving money before we buy the home. Now we have other issues. There is student debt. There is corporate debt. There's credit card debt. Can you survey that and tell us if we are headed to another problem?
So the kind of four parts of consumer-oriented debt. We've got household debt, credit card debt, auto loan debt, and student loan debt. And all of those figures are at record highs. And they are higher than they were before the crisis. Total household debt is a little bit higher than it was before the financial crisis. Student loan debt has gone from about $560 billion to $1.4 trillion. It's actually had the most increase relative to sort of regular citizens of the outstanding debt of those four pillars of debt. And part of that, again, is the choice. You know, had there been not so much of a spread between what Wall Street was getting money at from the Fed. So effectively part of this entire process of fixing the financial crisis that had befallen Wall Street, that it had nothing whatsoever to do with. My old boss, Gary Cohn, just said the other day that he doesn't understand why everybody's so upset with Wall Street. They committed no crime. And it's like, dude, this was the guy who was, you know, the former Trump's economic advisor, but he literally like said that in public, like on television. And it's like, these institutions have paid $160 billion, just sort of the top six of them, in fines for actual criminal and fraudulent activity over the last 10 years. I know someone in the audience is going to go into a little bit more detail on that with a question and some comments, hopefully. But the absurdity that we did nothing wrong. So besides the fact that they did, and they've had mitigated settlements really to sort of make up for the fact that they did those wrongs relative to the size of their books. Right, so there's over, for example, J.P. Morgan Chase, which is the largest bank. Jamie Dimon was Obama's favorite banker, and he was also selected at one point by President Trump to be, one of the chief members of his business council. So Wall Street plays both sides. Wall Street pays both sides, plays both sides. Where, though, it also is going wrong and creating another crisis after having been given all of these subsidies, you would think, is in the area of re-securitizing some of this debt, household debt again, consumer debt again, student loan debt again. It's not getting quite so bells and whistly at it because that was a problem 10 years ago. Where it is getting bells and whistly and having more complex securities created in the exact same manner off of which they were created in the subprime crisis in the corporate market. And particularly in the emerging market, corporate market. So whereas we talked about, and Marcus talked about CDOs, collateralized debt obligations, as did Professor Wilmar, the reality is that there's been a doubling in corporate debt in the last 10 years as well. Much of that has been extended through the same banks, kind of like what they did with the subprime loan market. A lot of that debt's very junky. Similar to the subprime loan market. They create the ability to then repackage debt multiple times because it's more attractive to package crappy debt and make it look better than it is to repackage good debt and make it look better. There's just not as much money in that. So as a result, there's a record issuance of something called CLOs, collateralized loan obligations, which are like CDOs with like a letter change. That's stealth. And that's predominantly the same types of securities and cascades of credit derivatives and everything else on the top of corporate loans. So again, you have more debt created, you have more loans created, you're still securitizing and complexifying all of those securities again and again and again. When you start to see defaults in corporate loans, which we are, then that exact same process starts to happen again, which is these little corporate loans are feeding up all of these other bigger beast of complex securities, and then they start to default, money falls out of the bottom first, and then it basically topples that whole pyramid again, and that's what's really happening now. So we are creating, in the wake of last situation, other crisis, we're just creating it from a higher height. We're creating it from having subsidized the market for 10 years. So we're actually in a worse state than we were at before 10 years ago.
Could I respond? I know Bart did not mean to leave this impression, but it could have reached folks in a misleading way. You said, Bart, that the home ownership rate was around 65%, and then all this crappy stuff happened, and then it went up to 69%, and maybe there's a ceiling. The misimpression I want to correct is the following, that before the sharks got into it, there were some very careful, well-managed programs to make home ownership available to lower-income people and people of color. that really looked at ability to pay. And one of the most vicious things of all that was done in the subprime collapse was to blame this on aspiring homeowners. This was the fault of sharks in the financial industry. The aspiring homeowners who lost their homes were the victims. They were not the perpetrators. And half of the subprime loans that were targeted at African Americans went to people who qualified for conventional loans. And so the home ownership rate could be close to 70% if the Homeowners Loan Corporation were running the damn thing. If con artists who were not taking advantage of borrowers were not in charge. And I think to leave the impression, and I know this was not your intent, but this is a right-wing talking point, that this was the fault of nefarious people of color who had the temerity to want to realize the American dream and become homeowners. That's just garbage. That's crap. And it's not true. And every time you hear somebody make that argument, you owe it to history to acquaint them with the facts.
I just have a chapter very quick, and it takes a pillage. I just have a chapter in the book I wrote as the crisis was happening called "It Takes a Pillage," and it's something like this was never about the little guy, and it actually goes through that whole pyramid explanation of why it wasn't the sort of borrower's fault. You know, the borrowers didn't create this like massive over-leveraged, you know, sort of pyramid Ponzi scheme in the world. They didn't do that. They basically, you know, borrowed money to buy a house. And a lot of stuff happened at that level too. But why the financial crisis happened was because banks could basically, you know, sort of muck around with that to an extreme amount of profit on their behalf to record share prices now, and all of the stuff in between.
Thanks. And thanks, Bob. I was going to return to that, but let's dwell on that. I am charmed, if not appalled, by the argument that somehow the financial crisis was caused by lower-income borrowers snookering Goldman Sachs.
Yeah, right.
I'm wondering if you can expand on your history with the Community Reinvestment Act and to address Peter Wallison of AEI's argument that you are to blame for the financial crisis.
Well, the Community Reinvestment Act very, very carefully wrote the following phrase, consistent with sound credit standards. And in fact, Jim, maybe you can help me on this. What was the legislation in 1993 that Greenspan decided to ignore that basically...
That was HOPA. The Homeowners Equity Protection Act.
Yes, the Homeowners Equity Protection Act. Thank you. The Homeowners Equity Protection Act basically made it illegal to do the whole edifice on which subprime was based. It made it illegal to make an unsound loan. And Greenspan said, we don't need this. And one of the members of the Board of Governors, now deceased, was kind of jumping up and down saying that, I'm forgetting his name.
Ned Gramlich.
Yeah. You know, jumping up and down saying, this is going to crash and burn. You got to stop this. And they all said, not a problem. Yep. So there were voices in the wilderness, Brooksley born. And it's not like nobody saw this coming. But to blame this on efforts to extend home ownership to lower income people, Community Investment Act very, very carefully said you have an affirmative duty to provide credit to the entire community consistent with sound lending standards, so that the people who perpetrated this disaster violated CRA. Far from being compelled to do this by CRA, they violated CRA.
Thank you. I'm trying to construct this question as whether we should go back 10 years and Obama makes a surprise decision of the odds were on Geithner, but instead he chooses a lesser-known staffer on Barbara Boxer's office named Marcus Stanley to head the Treasury. That might be the easier way, or we can... And so we do have a mortgage crisis. We do have banks that are underwater. Congress is ready to authorize substantial funds. How do we do the bailout better?
Well, I think the person that he should have appointed Treasury Secretary was not me, although I certainly would have. That would have been a very interesting experience for everybody involved. But Sheila Bair, she was there at the. She was a Republican.
And
she
a
was
female.
at the FDIC, and she had responded to the failure of IndyMac and to the failure of some of these specialized mortgage lenders with an emphasis on restructuring mortgages. She had the modifications in a box that she was providing, and she sort of put the borrower first. And the bailout programs were not conditioned on sort of writing down the mortgage debt at the banks. They were not conditioned on taking those mortgages and bringing them down to the true value of the house. They were about saving the banks. And so what they put first is actually, how can we get people to continue to pay off at the inflated cost of their home in order to subsidize the banks and supposedly save the financial system. And so you've got that sort of flow of subsidy going from regular people to the banks, and of course the banks are just trying to sort of patch up their own wounds and stop their bleeding. They're not spending this money, and the ordinary people who are paying this money into the maw of the banks are cutting their spending. So there's an enormous, and this is what Mian and Sufi traced in their book, there's this enormous macroeconomic effect in terms of spending, and you get the effort of government placed not to sort of reflate the ordinary Main Street economy and allocate these losses to wealthy people who will see a decline in their wealth, but probably won't stop spending because they've got more wealth than they could ever spend. It hits at the level of ordinary people, and so you see this massive increase in inequality over Obama's presidency. You see the proportion of wealth. I actually don't have the numbers at my fingertips, but they're on my computer at home. You see the proportion of wealth held by the top 1% in this country, or the top, I think, 0.1% go up from something like 15 to 20% over the period of the bailout. So that was number one, and the other dimension of it is you had to get this spending power and this muscle of the federal government into fiscal policy. There's this very artificial division between monetary policy and fiscal policy that Washington wonks like to use, and fiscal policy is where regular people actually get to spend money, but monetary policy is the mysterious workings of the financial system, make sure that money is at its properly defined level, as defined by these sort of alchemy of economics that's somewhat pseudoscientific, and that we had to get the muscle of the federal government behind supporting state and local governments and supporting communities, preventing layoffs. If we had just kept the proportion of public employees to population at the same level it was in 2008, and we had kept that proportion stable, then 1 million jobs would have been saved over the recovery. And for the Democratic Party to let 1 million public employees lose their jobs, get laid off, not get hired, these are disproportionately minorities and women, but these are middle-class people that should be the core of the Democratic coalition. For the Democratic Party to let this happen, it's a farce. And then you compare, in contrast, again, when the Republicans got in, they somehow found $1.5 trillion for a couple of tens of thousands of the wealthiest people in the country that they managed to, with alacrity, within months of getting elected, lavish on these people. So, that's... Ben Bernanke had a very interesting proposal where he he proposed, and I contacted him a lot trying to get him to speak out more about this, but he just buried it in a blog post, and he refused to speak out about it more publicly. Instead, he wrote this op-ed. But he said, the next crisis, perhaps the Federal Reserve should deposit money into an account for Congress to spend that we could spend debt-free, that we could simply, the Federal Reserve would simply create money that Congress could spend through ordinary spending programs and do it without increasing the debt. This is, using the federal government's money creation power to actually build infrastructure and support jobs when these things happen. And I think that's something that we should follow up on.
Thanks, Marcus, and for you, Professor Wilmarth. We all agree, it's undisputable, that the financial crisis was bad. It is debatable, but a number of us believe that it happened because commercial and investment banking were allowed to come together, and a lot of bad things happened from putting those two toxic chemicals together. Who does Glass-Steagall benefit? Well, we can argue about it. The New York government looked at senior pay at the crash, and they found that about 2,000 people at J.P. Morgan made more than $1 million a year each. And given that J.P. Morgan is about a fifth of the banking sector, just multiply by 5, and I'll just say this, there are 10,000 people, 10,000 bankers that make more than $1 million each at Glass-Steagall authorized banks. I could be off by a bit. But 10,000 people is kind of a low attendance day when the Nats are winning. So that's 10,000, and we know the millions of people that were devastated. So Art, what's the argument to sustain Glass-Steagall? What good does it do other than help to make these 10,000 bankers rich? And
You mean what good is non-Glass-Steagall?
yeah, what good is
non-Glass-Steagall.
is joining the banks? What good is separating the banks?
Well, I think to me, the separating banks from the capital markets has multiple, dividends. It has economic dividends because you're creating resilience, you're creating risk separation. I mean, it was interesting that when the stock market crashed in '87, it didn't bring down the banking system. In fact, the banks helped out the securities firms because they could. Now, the Fed helped also with discount window loans, but the banks weren't crippled in 1987. In 1998, which was sort of toward the end of where Glass-Steagall had some impact, the Russian crisis happened, and again, the banks were able to help out the securities firms. Contrast, Drexel Burnham failed in 1990. It was the fifth largest bank. It was like Bear Stearns at the time, fifth largest investment bank. When Drexel Burnham failed, I mean, it was a significant failure, but it didn't bring down the banking system. So, this idea of risk separation, there's resilience, there's not automatic contagion or spillover. You put them all together, what Mark Twain said, you can put all your eggs in one basket, but you better watch that basket, right? So we put everything in one basket, and we didn't watch the basket. We took all eyes off the basket. So I think you have economic resilience and risk separation. Maybe more importantly, you have political separation. I think someone made the point that back in the day, the banks were fighting the insurance companies, were fighting the securities firms, were fighting the small bankers, were fighting the insurance agents. You had about a 5 or 6 quarter fight going on. I think Bart made this point. So they checked each other, right? Well, our whole system of government is based upon the genius of checks and balances, right? We took all checks and balances out of the financial system where we combined them all together. And so the big conglomerates could overwhelm everybody. We've got to go back to that, where no one sector of the financial system dominates our politics. That's what Louis Brandeis was talking about, in 1914. Other people's money. That you had a financial sector that was dominating politics, and that had to stop. It didn't really stop until 1933. And I think economically, Bob made the point about antitrust. I mean, I think that antitrust doesn't work in the financial sector. We don't have good good mechanisms for it to work. Glass-Steagall was a form of antitrust. No one firm could get too big. I mean, you now have 4 giant banks, or 6, I guess, 6 giant banks that basically control 100% of GDP in terms of their financial resources. No wonder no one can really challenge them. So that I think for a number of reasons, economic resilience, political checks and balances, bringing back any notion of antitrust, competitive forces, Glass-Steagall would do all those things.
Thanks. Now we turn it to you for questions.
Since I'm again retired, I don't have the requirement of taking a transcript of this entire talk and being able to know who was saying what, since I was too far back to be able to match. But I applaud much of what I heard, perhaps 95%. I'd underscore in yellow highlight. 2 things were particularly offensive, having been at AEI sessions many times and engaged in attempts to get Peter Wallison to straighten out his thinking. Yes, I'm Gary Koff. I was an officer at Fannie Mae for many, many years. I was an official at HUD for many years. I came out of retirement in 07, 08 to brief the class action bar on how to take on the big banks for what had gone wrong. And I did 14 major cases. We didn't take down any big banks. We cost them a little money. We didn't get any individuals indicted for criminal actions. That was left to the Justice Department. I think their record, like ours, was 0 out of 0. The 2 things I thought should have been corrected, there are 2 words that in audiences like this I think have to be addressed carefully. One is securitization, and the second is banks. Several gentlemen here have tidied up the record a little bit on banks. There are a number of banks in this country. Forget investment banks for a moment or trying to tease them out of the mergers. There are community banks and other larger versions, and then there are the 6 that were eloquently mentioned. We all perhaps, or some of us have our favorite statistics by which we show that there are really only 6, or maybe it's 8, maybe it's only 4. So when you hurl invectives at banks, you have to separate the big ones, the really big ones, from all the others that are desperately trying to do their jobs day by day. Second, securitization, and I'm a bit defensive on this. I spent much of my life on it, from helping create the Ginnie Mae program in the early days, the Fannie Mae mortgage-backed security, and then being hired by the World Bank to take securitization throughout South America. Securitization, up until approximately 1999, maybe 2004, worked fine. Johnston at Fannie Mae got a little aggressive. There were a few problems. But the real problem with securitization and bringing up home ownership, including for low-income persons for whom Fannie Mae worked very hard to provide home ownership, the real problem was when Wall Street took securitization, which it had tried to take away from Fannie Mae and Freddie Mac when the REMIC legislation was created, and at earlier points as well, because they wanted the profits that Fannie and Freddie were creating. But the real problem wasn't stealing Fannie and Freddie's business. Compliments of the same 3 characters who you've mentioned. Fannie Mae and Freddie Mac were simply hip-checked off the ice and put in the penalty box where they still reside today. The securitization was turned into, with credit default swaps, into CDOs, as was described. One of the things that's least known in the world in which many of you speak, first is the guilty parties at the big banks, because they aren't really identified anywhere, so you maybe can't say they're guilty. And the second is who really lost the $1.5 trillion to $3 trillion invested in CDOs, because they were so private. The SEC doesn't really know and couldn't help. Even when the landmark legislation nailing Bank of America and Merrill Lynch and Countrywide reached the largest settlement, the largest share of that $160 billion. Some of us who've laid out all the CDOs that were in Bank of America, Countrywide, and Merrill, the losses on those CDOs were multiples, times 10, times 100, of what they paid the federal government when the government Department of Justice praised itself for nailing 40 or some billion dollars. Securitization, once the record is clean, and one might say, why bother cleaning it up? Because the solution, if we move into the forward perspective is bringing Fannie and Freddie out of the penalty box and hoping one can reattract enough good people to them to rejuvenate the mortgage markets that took a horrible hit in Dodd-Frank. They weren't helped, they were hurt. There's still time to do that, and Fannie and Freddie still sit in the penalty box, and until I mention it, and many of you may say, why even bother? Shouldn't they just be shot and carried off? That's the solution. And there's 40 years of history and development of sound underwriting that was good until 2004. That is the basis for the new salvation of the mortgage markets. I'm not one of your panelists, so I'll stay down.
Okay, thank you. Yeah, thank you. And this is a standard experience for me where many in the audience are as or more expert than many on the panel. Given that we're hoping to get through a number of other questions, if we can be briefer with some of our... Yeah, maybe, or maybe two, because I know there are some experts. And then if there is a question, that would be great.
Definitely a question. My name is Peter Rush. I'm from Leesburg, Virginia. I've been looking at this stuff as somebody as an amateur, but I think I've been better than lots of professionals for a long time. And I've actually written some chapters for a book I've never published that goes through some of this stuff, and so I've read a lot about it. And it's clear that the housing market alone problems in the 2000s was not what caused the crisis. It would have been no worse than the S&Ls proportionally if that's all we'd had. It was the derivatives on top of that unraveled the whole thing. The only thing that scares me right now, worse than watching what Trump is doing today, is what will happen if we have another crisis and his administration, as bad as Bush's was and Obama, I can't fathom how his team would respond and what we would do about it. So that's sort of what we have to prevent from getting to that point, and that's where my question comes in. I'm hearing what you're saying is that we not only have pretty much a similar level of derivatives on top of everything today, now perhaps more on top of the corporate loans structure than we had before on the home loan structure. But I'm hearing that we also have a lot more total debt period than we had in 2008, if that's correct. But we also have, it seems to me, other areas. Earlier, before the thing started, Arthur was mentioning that China could be the weak link internationally and it could blow, or Europe, which are worse leveraged than we are in terms of debt to productivity ratios. But we also have Argentina, which added $100 billion in 2 years under this moron Macri, and they're going to blow at some point. Before we have Iran, who might crash financially. We have Venezuela. We have Turkey. We have all these things could also add on to everything else. So I'm wondering, what prospects we have for a fairly near-term crash, and number two, in addition to Glass-Steagall, which we would have to push for, it seems to me, I have a better appreciation for why that's urgent now as a real solution. I knew we had to modernize it, but actually I hadn't realized how comprehensive it was. But what else could we be pushing for, including things that banks who have some sanity might realize they want to do them to even help save themselves? Are there things that they can do before it crashes to ameliorate and start mitigating the potential crisis? It may not prevent it, but mitigate it. So it's sort of several questions in there, but thank you.
Thanks. Go ahead. Did you want to take that, Naomi?
I mean, I think about it. It's.
Right.
I just want to say I think it's cool that we all just want to like jump at all of this because it's as many times as, and the three of us, Marcus and Bart and I were actually at Senator Sanders' office this morning, which we can talking about too big to fail and some legislation he's going to introduce as well. But we just want to keep talking about this, and we understand you guys have 2 hours, and we're glad you're here. I'm speaking of, but and so I'll give this up in a second. I know I tend to go off, but on the whole CDO Fannie Mae securitization element of this, it is true that securitization itself, which is the first kind of rung around, looking at an upside down pyramid on a loan, the very next part of that upside down triangle would be the securitization level. And that's basically taking a lot of loans and putting them into one security. And slicing that security into some pieces, not a ton. It used to be just a couple pieces. They're called tranches. It's French. I don't know where that word came from. Just pieces of this bond and giving them out to different people based on how likely it was that the loans that were stuck into them would repay. So in other words, this is I usually do this with like lots of. It basically is saying that like if certain loans repay, if all of the loans in a securitized vessel repay, all of the bondholders, everybody who bought a piece of it gets paid. But if things start to not pay, then certain people have dibs on getting their money back versus other people, depending on what slice they bought. It's bigger than that. However, that really, it's true, wasn't the major problem. The major problem was all the other layers on top of that. The major problem was, yes, credit default swaps. The idea that companies like AIG could basically insure stuff they didn't even own and had no tie on, and could get money from a company like Goldman Sachs, who never gave an actual loan to a real person ever. And so the mechanisms that allow that credit transfer, that sort of risk of default, of anything defaulting, the securitized product, the CDO, a credit default swap, which they actually can default. A party on the other side might not be able to pay insurance on taking the bet on the other side. It's like you go to Vegas, you put down $100, you lose it, and you ask like 25,000 other people to lend you $100 because you say, I actually had this $100, I'll get it back, I'm good for it, but you're not. It's all of those things, all of those elements that could be structured. And it was part of what happened in Glass-Steagall repeal, because as part of that repeal, credit default swaps and swaps themselves were basically taken out of having to be transparent. So banks could do stuff off balance sheet. All CDOs, and while we don't know where they all are, they're all off balance sheet. There's 80 pages of documentation per each CDO. I've written some of those, but it's all or most off the books of banks when they get created and also when they fall apart. So that's why they were so scared. There were so many losses outside of what the bailout or the Federal Reserve subsidies that still ongo had really, basically been able to cover, that was the ultimate fear of a lot of these institutions, that stuff would start to crumble in. And that's why all the people that ran these institutions like Hank Paulson didn't want that to happen. And in terms of the other stuff, actually, I'm just going to, but the other debt that's out there, Argentina, Turkey, all of these things are all parts of that risk. There are still credit derivatives written on like little tiny corporations in Argentina and in Turkey. And so it's not like none of this stuff has stopped. It's just sort of, it's like energy. It's like it doesn't really disappear. It only transforms from one form to another. That's exactly what's happened. The risk is still there. It's just maneuvered over. But the engineering, the idea that banks still have as collateral our deposits and regular commercial and regular individual loans is what allows them to remain too big to fail. It allows them to maintain as hostage sort of our money and other people's money relative to all this other stuff they're doing.
Bob, Steve, and then I'm going to warn everybody, I'm going to be Mr. Tough Guy, and I'm going to start putting this thing up, so be warned.
I want to take polite exception to the contention that securitization was basically okay until 2004. I think, and I even want to take polite exception to something that Nomi said, I think sorting securitized mortgages based on the likelihood of their repayment is a bad idea per se. The whole purpose of underwriting a mortgage is to make sure that the bank gets paid back. And if you think the person is not quite so good at credit risk, you ask for a higher down payment. Or maybe you ask for private mortgage insurance. The whole idea that you can sort mortgages according to the likelihood that they get repaid is what opens the door to all the mischief. If you think they might not be paid back, you ought not make the mortgage. And the home ownership rate did just beautifully, thank you. It went up and up and up based on sound underwriting. I think Fannie Mae went off the rails in 1969 when it was privatized. It worked perfectly well when it was an agency of the federal government, and mortgages were packaged and sold off as bonds, and that replenished the ability of local banks and local savings and loans to make more mortgages. Somebody said, let's make banking boring again. Amen.
Thank you. And again, I'm going to flash this when you've gone. You got about 30 seconds left.
Hi, my name's Mark Fairchild. I'm a private citizen. I am an enthusiastic supporter, though, of Glass-Steagall and have been for many years. I'd like to bring up the question of objections to Glass-Steagall, something that if you're talking about this with friends or, for that matter, in Congress, you're likely to be hit with. One objection that I have heard is that if we were to restore Glass-Steagall now, it would cause a sudden and savage constriction in credit, which would cause chaos, and therefore you cannot do Glass-Steagall. And I think this is actually what motivated one statement was, well, you can't put the toothpaste back in the tube. So secondly, I've heard the objection brought, and I'd like the panel to comment. Do you think that's true? Would it cause a savage constriction in credit, and if so, what could be done to overcome that? Secondly, I've heard the objection brought that you can't do Glass-Steagall because if the United States just does it, then our banks would no longer be able to compete with the other global banks, which are perhaps not constricted. And I would like the panel to comment on whether they think that's true, and if so, how to overcome that.
Thank you.
This is a job for Art Wilmarth.
I think there would certainly be an adjustment. I think over the long term, Glass-Steagall would probably lead to less credit, which I think would be a good thing. Who thinks we have too little credit right now, right? Just some numbers for you. Global credit went from 84 billion in 2000 to 173 billion in 2008, and is a trillion, sorry. To 250 trillion today. I mean, so we're on a treadmill to Armageddon once again. So I think that the idea about restraining credit would, to me, be a virtue rather than a vice. Now, would there be possibly an adjustment that might have to be made? I think the Fed could probably step in during that adjustment period. But if you go back to the days when we did have Glass-Steagall, you had a very competitive banking industry. You had a very competitive securities industry. They were beating their competitors around the world. I mean, so that it wasn't as though they were doing badly back then. So I think that this notion that our banks can't compete, that it wouldn't work. I mean, I think the evidence from the 60s and 70s and early 80s would suggest otherwise. That my view is they could hardly do worse, right?
Well, I would add, Art, that we have a bit of an experiment with that, with the Volcker Rule. The Volcker Rule restricts proprietary trading, the gambling part of banking. The Securities and Exchange Commission just issued a study, the congressionally mandated study last August, that showed that liquidity, or the availability as well as the transaction in credit, has not been harmed. So with banks supposedly barred from proprietary trading, Glass-Steagall Light, I think we haven't seen an evaporation of credit.
Of course, is that because the Volcker Rule wasn't really implemented
Yes.
very forcefully? So.
Well, and we put the toothpaste back in the tube after 1929, and the real economy thrived.
And we've got about 15 more minutes total, so, pardon me.
Jim, before you speak, come here. Make a 2 minutes thing on your case. Let them know. No, go ahead, ask your question, and then I'll go. All right, ask your question.
Okay, all right. So I'm Jim Vittorello, old friend of Bob's and Professor Wilmarth. I just retired from GAO after about 25 years as a housing specialist. And I mention that because I was involved in virtually every banking and housing study GAO did between 2004 and 2017 when I retired. So I have a lot of inside and outside knowledge about what happened and et cetera, et cetera. But I'm going to comment about Fannie Mae because the gentleman from Fannie Mae forgot to say a couple of very important things about the difference between securitization with the GSEs versus Wall Street, which is, I think, very, very germane to this. But my basic question is, all right, after the collapse of Fannie and Freddie in September of '08, right, same month as Lehman Brothers collapsed too. And I remember very distinctly how the credit markets completely froze, not only here,
Right.
but literally
Yep.
around
Yep.
Oh, yeah,
the
no
world.
question.
And while I didn't agree with all the bailouts, and I worked on TARP and the HAMP program with mortgage foreclosures and mitigation and all that. I still am puzzled about what the federal government could have done to unfreeze those credit markets without giving the store away, which certainly Paulson and Bernanke did, without any strings attached at all. I still haven't heard an alternative from you guys about what should have been done. You can't just sit there and let the credit markets freeze and say, okay, fine, we're going to wait until they come back, right? All right, so that's my basic fundamental question. But I want to point out something very important about Fannie Mae that I learned during my studies. Number one, they had a terrible accounting fraud problem in '03. And guess what? Their securitization market share went from 65% down to about 35% in literally 3 years, 3 to 4 years, from '03 to '06. Guess who then came back up exactly the same time? Wall Street. That was a vacuum that was left that Wall Street was dying to jump into. And when they saw that credit thing happen, that accounting problem, and their regulator basically froze a lot of their portfolio loans, which were their riskier loans, et cetera, that's when they jumped in like wolves and took over. And the other big important difference that no one, I'm surprised, mentioned this, Fannie and Freddie never had CDOs, tranches, none of that. And in fact, they guaranteed their securities. Wall Street never guaranteed their securities. It was a simple MBS, very simple. I disagree with Bob. I think if it's done the right way, which I think Fannie and Freddie did for many, many years until they got too greedy, I think that's a great way of providing 30-year fixed rate loans, because banks cannot make 30-year fixed rate loans based on short-term deposits.
Oh, I
So
agree
on.
with that. Yeah.
Ken?
Right. So that's a big difference. Oh, and one last final thing. The gentleman didn't point out the reason why Fannie and Freddie collapsed, and I know this absolutely for sure. They were the biggest purchasers of Wall Street MBS and CDOs. Bingo.
Thank you. Go ahead. We'll respond when you've had a chance, Mr. Pellegrino.
I'm sorry to interrupt. Apparently the entertainment interlude during the questions. My name is Paul Pelletier. I was a prosecutor in the Department of Justice for over 27 years, prosecuting white-collar crimes for all that period of time. I happened to be a prosecutor at the time of the financial crisis.
Can you use the mic, please?
I am. Okay, I'm sorry. Usually people don't tell me to speak louder. So anyway, I will tell you that I agree that part of the fact that President Trump is now the president is, in my belief, a large part due to the bailout. I will tell you this, though. I've spoken to, I don't know if you know, but Marketplace on NPR is doing this retrospective of this. And they said that the number one question everyone asked them is, why wasn't anybody prosecuted? Mm-hmm. And so I believe if people were prosecuted, it might have changed the dynamic for the election as well. And the people weren't prosecuted for 3 reasons: competence, commitment, and courage. Those are the 3 reasons. I'm not an economist like these guys that they know what they're talking about, but I'm a prosecutor. I was an economics major, and I'll give you the macro and the micro just to prove I was an economics major. But the macro, competence. No, let's talk about commitment. You remember in 2002 when the Enron scandal hit. What did they do? The Department of Justice started the President's Corporate Fraud Task Force. And within 1 year, they had prosecuted over 500 executives. They empowered us prosecutors to do it. And they did the same thing 10 years before at the savings and loan crisis. We prosecuted over 1,000 banking executives. They empowered us to do it. People need to know there's a cop on the beat. That's how we regulate. That's how it's called, what we call in the Department of Justice, it's called justice that's done in a way to make people believe in the system of justice in America. And so I'm going to just fast forward now. So that's commitment, competence. When the Enron scandal hit, they said, fraud section, which I ran, go teach prosecutors how to do this, how to prosecute accounting fraud, which is what we did. In 2008, nothing. Not only that, They didn't start a new task force until almost 2 years later, November of 2010 is when they started a task force. They didn't even have to start a task force. I'm like, just bolt on a mortgage fraud component to this task force, to the corporate fraud task force. Didn't want to do that. And then courage. In 2008, I was in Connecticut waiting for the jury to come back on my trial against 4 Gen Re and 1 AIG executive who we had tried because Hank Greenberg had jimmied the books as of AIG. It was my 3rd shot at AIG, by the way. And this second one, we were waiting for the jury to come back. They came back, convicted everybody. But while we were in the jury room waiting for them to come back, we get a call from AIG. AIG says, we have a problem with our numbers. We've announced some bad numbers. And I don't know, when we met when this whole thing started in 2009, Senator Kaufman came in, he took Biden's place, and he said, Paul, what laws do you need to prosecute this fraud? I'll make sure we'll enact them. You know what I said? I said, none. We have bank fraud, we have wire fraud, and we have mail fraud. That's all we need. If you start, we don't need more regulations to prosecute. We just need those 3 fraud statutes. What we prosecute in the Department of Justice is lying, cheating, and deceiving. And that's what AIG did. And so I urge you to read the book. It's called The Chicken Shit Club. It goes through exactly the evidence that we had against AIG and Joe Cassano. This is not my first rodeo with Joe Cassano. I had prosecuted AIGFP in 2003 for what they did in jury rigging the books. So all I'm saying, that's the micro on courage. I tried to do it, and you know what my bosses told me at the Department of Justice? Can you guarantee me a win? Now, I had been doing this for 25 years, and no one had ever asked me that question. Any white-collar prosecutor that guarantees anybody a win is so crazy you better not trust his guarantee. So I said no, and within a year I quit because I couldn't fulfill my constitutional duty anymore. And I agree, Bob, with your statement that we need more politicians that get this, that will fix it. I ran for Congress this past June. I lost in the primary, but I'm trying. That's all I can say. Thank you.
So I just want to quickly respond to Jim's question. You have to differentiate between October and, say, January, February, March of the following year. So obviously, when the credit markets are frozen, you have to do whatever it takes to unfreeze them. That's what lender of last resort is all about. But in January and February and March and April, when you had this epic battle between Sheila Bair and Elizabeth Warren on one side, and the Gang of Three on the other side, Summers and Bernanke and Geithner, the fight was, do you prop them up or do you bail them out, or do you clean them out?
Yeah.
And Sheila Bair's model was the kind of resolutions that you do at the FDIC. She argued that what you ought to do is the same kind of resolutions with the big banks. And a combination of cronyism and corruption on the one hand, and genuine concern that the system couldn't take it on the other hand, led Geithner and Summers and Bernanke to resist that. But surely Citigroup should have been broken up, and maybe several of the others, because in a normal bankruptcy, in a resolution, the shareholders lose everything, the bondholders get so many cents on the dollar, and then you got a clean bank. And given the kind of public capital that was put in, we should have had that sort of resolution, and they didn't do it because they were corrupted and because they were scared.
Yeah, and just to add to that, there's a great study by a really well-respected economist named Viral Acharya. It's called The Unintended Consequences of Lender of Last Resort Facilities, which is a wonky title, but basically what he found is that the bailout programs that were supposed to get lending started again were actually encouraging illiquidity. They were encouraging the banks to sit on their hands and not do anything. And what was the reason for that? Because they knew that if they sold off their bad assets, they would have to take a visible loss. They would sell them at a loss, so they would lose money, and there goes their annual bonuses. And as long as the federal government was giving them money, they didn't actually have to do that. They could keep their heads above water. So what he said was a very basic, simple thing. He said, well, let's put pressure on the bad banks to get out of business. And if we're going to help anybody, we should be helping the people who are healthier to come in there and like get some bargains. And that's what's going to get the markets going again. That's number one. And the second thing with this, one thing that drove me insane that whole time I was there is the federal government has to be willing to step in and actually have the courage to set up public programs for credit and public programs to do things. We are is such in sort of this Ayn Randian pure market economics trap that there's a fear of the federal government actually coming in and doing anything active, like taking control of the banks temporarily, or like taking a more active role in the housing market. You know, the federal government was perfectly placed to take a more active role in the housing market. We had the GSEs, we had data on every single mortgage in the country. It's very easy to model not easy, but it's very possible to model what the fair market price of mortgages are versus what the actual mortgage is. And the federal government was really unwilling to come in and cut that Gordian knot of all the legal rights that came out of the securitizations, and just take a more active role in getting credit to people. So.
Thank you. We'll have one last comment. I'm beginning to see that one of the reasons we get in this mess is we are unable to reduce our comments to tweet length. After we finish with this final comment and question, Bob and Nomi will stay and sign books for you. If you have cash, Nomi's only $20, a special tonight.
So is Bob's.
And so is Bob's. Very good. So final comment.
Thank you. My name is Mark Tenney. My name is actually on the Federal Reserve webpage, and you may think it's their list of criminals on the webpage, but actually I don't make enough money to be a financial criminal. This is my best belt. So my question, though, is primarily to Marcus Stanley, because I've been reading your papers on criticizing the stress tests as too weak. And as you know, the Federal Reserve has a model validation council of 5 academics. Monica Piazzesi is one from Stanford. Yes, ma'am. Monica Piazzesi of Stanford, who's written on affine term structure models, quadratic term structure models, and I invented quadratic term structure models. Greg Duffy's the chair of the committee, and he's cited my research. And so I actually have a proposal for you, which is that you and I talk to these professors on the Model Validation Council and present your concerns, and you have a broad knowledge that I don't have. But I have a very specialized knowledge, and they're familiar with me. So we're a perfect pair.
What a great note to end on. My God. Take it and run.
Well, another round of applause for our panelists. Thank you all for coming.